Hey, this is Chris Franco, and you are listening to Compound Money Quietly, the CMQ Investing Podcast. CMQ investors, welcome to the show. It's great to have you here. This episode is actually something that I had planned on recording, but I actually decided to do during an Instagram Live. The consensus was value was added and to publish this as is. So I want to get out of the way and give you what you want. Let's get to it. In this episode, I want to talk about how Warren Buffett made over $100 billion from his investment in Apple. I find that when people talk about Buffett, and I'm by no means am I a Buffett stan, but I think they tend to think that the Apple investment is sort of like this non-event. You know, anyone could have picked that. I mean, he finally got into tech and bought Apple, but I mean, it's Apple. That's a sentiment I seem to glean a lot from the internet. And whether or not that's what you believe, that's fine. But what I want to share with you today is what I've learned from that investment in Apple and how that lesson is something that I've applied that's working out pretty well for me. Let's first start off with the obvious. The only time you're going to buy an individual stock is if you think it's going to outperform the index over a long period of time. Now, there's no formula for finding a stock like that, but one way to improve the odds would be to buy a stock when the expectations about that stock's future, or that company's future, I should say, are low. Michael Malbausen, who's one of my favorite authors Michael Malbausen, who's one of my favorite investing authors, puts it like this: stocks that outperform the market tend to start off with low expectations and then consistently deliver results better than what the market anticipated. And that description applies to Apple in 2016. That's when Warren Buffett started buying shares. Now, when Buffett initially bought these shares, well, it wasn't announced until the following quarter when the disclosures came out, or whatever they call that. I'll have to make sure I get that lingo right. But he started buying shares of Apple in Q1 of 2016. Now, in Q1 of 2016, Apple was not this, hot stock. In fact, Fortune magazine published an article in January of 2016 calling Apple a risky stock. And if I have the quote here, they even went as far to say that Apple has a future, I think it was of low expectations. Let me find exactly how they put that. Let's see here. Yeah, the article's author. So the Fortune article's author, his name is Sean Tully. He said that the iPhone maker had, and I quote, entered a new world of ultra low expectations. So Warren Buffett was aware of these ultra low expectations, but he was busy buying up shares. And in fact, in Q1 of 2016, he bought his first about 10 million shares of Apple. Now, you might also wonder, what were other people doing? Were other people buying Apple? What did the, investment world generally think beyond just the analysts? Well, when the news came out, or shortly before the news came out that Buffett had bought Apple, one of Apple's largest investors, Carl Icahn, told CNBC that he had sold all of his Apple shares. In fact, he said, and it was a lot of shares, by the way. Icahn had previously owned approximately 1% of Apple's outstanding shares prior to liquidating his position. And it wasn't just, Fortune, it wasn't just Carl Icahn, it was a number of other analysts who came out and said that essentially they had low expectations about Apple's future. This did not continue, when Buffett announced that he had bought 9.8 million shares, it wasn't as if that just reversed the expectations that people had about Apple. In fact, throughout the rest of the year and into the next year, into 2017, expectations continued to be low among analysts on Wall Street. Buffett kept buying, though. By the end of 2017, Buffett owned 165.3 million shares of Apple. And in the first quarter of 2018, he bought an additional 75 million shares. So I could get into, this being all about, why did Buffett buy Apple? And we could talk about the franchise qualities, the fact that there is a very sticky customer base, the fact that he, liked what he discovered during his due diligence process, where he applied the scuttlebutt method made famous by Phil Fisher. I could go on all about that. But really what I want to talk about is how when you buy an individual stock, you're not going to do exceptionally well, or you shouldn't expect to do exceptionally well if you buy a stock that everybody believes has a bright future. If the expectations for a given stock are, very high, well, it's probably priced in. When the expectations for the future of that stock, or I should say the future of that company, when the expectations are low, that tends to be priced in as well. And that would be the time when, or that would at least give you the opportunity to see something that others missed. I've talked about this in a previous episode about second level thinking, but this is the time where, you would see something that others missed, you would disagree with the consensus, and you would be right. And that perfectly describes Warren Buffett's purchase of Apple and where he was, I guess, mentally when he made that purchase and when he continued to make those purchases of Apple shares into 2017 and even into 2018. So the lesson here for me was about something I did in February of this year. The lesson here is something that I applied in March of this year. So on March 3rd, I purchased shares of Intuit. Anyone know what Intuit is? Intuit is the company behind QuickBooks, Mint. They recently purchased Credit Karma. They recently purchased MailChimp. Well, on March 3rd, when I made made the initial purchase, and I bought about, I think, the equivalent of 1% of my net worth of Intuit, the expectations were low. And the way I went about finding a stock that fit this criteria was using a filter. You're using a screener, and you're able to see in some of these what all the different analysts or research firms, if you want to call them that, what their expectations are, or what their recommendation is about the stock. So this wasn't something that I did just because the expectations were low. I had a lot of reasons for making this purchase, which I can always, potentially get into in another episode. But the point was, I deliberately sought out something where the expectations or the consensus about the expectations were that the future wasn't that bright, or that you shouldn't have a really optimistic view of the future. What happened though, I've been very right on this one, and I know what my process was, so it's not just me being lucky. I know what went in, the thinking that went into it, because I keep a decision log for any investment that I make, and that allows me to, just keep myself in check and have a great feedback loop where I can really see if I, deserve to have done well or if it was just pure luck. With Intuit though, I think I deserve to do well. And what's interesting is this past week, let me tell you the exact numbers, but earnings for Intuit were very positive. And in fact, the company had revised their guidance moving forward about what to expect in terms of revenue. As a result, and because I think in part because expectations were lower than I think they deserve to be, Intuit's stock shot up like a rocket ship. Now, it was already doing well for me. I had, it was one of my top performers, but on Friday alone, and let me make sure I have this correct. So on November 19th, which I believe is, that was Friday. On November 19th, 2021, Intuit went from 629 at close the previous day to 692 at close on Friday. So that's a pretty big jump. I think it's around 10% in a single day. Doesn't mean it's going to stay there. Doesn't mean that, I'm patting myself on the back for one day of great results. But it illustrates this point about finding companies where the consensus or the analysts on Wall Street, generally speaking, have low expectations about the future, or their expectations are lower than what your expectations are for that company's future. If you can identify those companies and you know what you're doing and you analyze the business and you've read the 10K and you've read the competitors' 10Ks and you're aware of all the psychological ailments that we all deal with that can prevent us from benefiting from this individual stock picking strategy that we're talking about, then that might be a good company for you to load up on. So it's just a great lesson. And I think, again, it's illustrated, and I learned rather from Warren Buffett's purchase of Apple. It's also something that just to go full circle here, this whole narrative that, Buffett never really got tech, but, he got Apple, but geez, it's Apple. It just, that wasn't really, the context of the time was different from the narrative that exists now. The context of the time and what people were saying then was, by no means was Apple a sure thing. Not everyone was, I shouldn't say not everyone, the majority of the Wall Street, I guess, analysts, research firms, they were not recommending Apple as this fantastic stock to buy when Buffett began buying in 2016. That is the lesson here. That is the story behind the lesson. I hope that makes this lesson more memorable. And I hope it makes us more aware of, as we're looking, if you do decide to buy individual stocks, which I know we all do from time to time, it's probably not going to be that great of a future for you if you're buying something that everyone is really excited about. The time to buy something that's going to do well for you, or do better than the average, I should say, is when not everyone's talking about it, when not everyone's excited about it, and when the consensus doesn't agree that the future is super bright. So I hope that's helpful. I see some hearts popping up here in this Instagram live that I have going on in the background. If you're here and you're paying attention, please, if you enjoyed this, if you've learned something, please hit those hearts so I know that this was an episode or this was some content that you feel like was valuable and that I should share. So hit the hearts if you're paying attention and you got something out of this. I hope I did a good job explaining it in a succinct, interesting, or in a way that's at least interesting for you, so you don't feel like you're falling asleep like a lot of the investing content that's online makes me do. I didn't include any ad libs, or I can always add those in later, but I see a lot of hearts going on, so that's awesome. Mission accomplished, guys. This has been Compound Money Quietly, the CMQ Investing Podcast. If you enjoyed the episode, make sure you subscribe. Please share on social media. And remember what Charlie Munger says: the best thing a human being can do is help another human being know more. I hope this episode did that for you. And if that's the case, then help someone else know more by sharing it with them. My name is Chris Franco. Thank you for listening. We'll talk soon.